Okay, I want to make something real clear for the beginners, in fact, because this is the whole reason why I started this, is for people who are new. I wanted to go over real quick on the importance of learning the concept, at least, or really grasping the concept of selling a put or selling a put spread. So, um, this is the SPY, right? The Standard & Poor's 500 is the ETF you can buy. So, all I'm saying, let's see, it's trading for $204.97, right? Or better yet, let's use something everyone knows. Let's use Apple just for. Okay, here's Apple. So 1 year chart for Apple. So let's say you're looking at Apple and you go, hey, earnings is coming out soon, or I heard Apple's is gonna do well or something, right? And you go, all right, I'll zoom in real quick. So Apple is trading right now for $112.98, and you go, I want to bet. I think Apple's earnings is gonna go higher. So I mean, it's going to be good. So I want to bet that Apple's going to go higher. Well, Apple is selling at $112.98, right? So you want to make a bet that Apple's going to go higher. Well, you're going to be betting against some of the things Apple's going to go lower. So instead of buying stock in Apple and owning, I don't know how many shares you want at $112.98, what if you could own Apple, say at, I don't know, what if you could own Apple at like $106? Well, Mark, how are you going to do that? It's at 112, and you know it's going to go higher, but well, what if you could own it at, let's say, $106 down here? So you give yourself a little cushion, because you see how it does this, up and down, here, it's going to go higher, right? Well, that's selling a put. Here's what I mean. I'm going to go to the trade panel. Here's the Apple expiration period. And you're saying, oh, well, and these numbers in parentheses are the number of days for this option to expire. So you can, and white means these are standard options, and the red just means they're weeklies, meaning they expire that week. So real quick, you'll be like, oh man, well I bet that in 55 days, okay, which is, and I'll scroll down here, which is the March right here. I'll bet that by this time frame, March, Apple will still be above, you're bullish. You think it's going to go up. It'll be still above 112. Okay. So if you look in your Thinkorswim, and instead of buying Apple at 112, you could sell a put. All right. So here's one. Well, roughly the strikes are $5 wide. So what if you could own Apple at, say, I don't know, $100 or even $97. See, these are dollars, right? How do you do that? Well, look, you're betting if you sell a put in Apple, the $100 put, here's what happens. You're going to sell it for $1.34 per contract. One contract controls 100 shares of Apple. So basically, you can make $134 per contract. What's the worst that could happen? So what you're betting on is when you sell this put to somebody else, that person is betting you that in 55 days, Apple will finish below $100 a share, right? Now you're like, well, what are the chances of you being right? You have an 80.4 chance of being right. The guy you're selling it to only has a 19.6% chance of being right. All right. So let's go to the chart again, right? Where is that? 112. You're betting that it'll stay above 100, which is right here, in 55 days. By this time, it'll still stay above 100. And if you're bullish on the stock, you're betting it'll keep going higher and higher and higher and higher, right? That's what I mean by lowering your cost basis. Now look what happens. What if Apple's earnings do badly here, and it drops down, and it swings back up? So I have to turn off my alarm. Okay, real quick. So let's say you're wrong a little bit, and it drops down a little bit. The best part about this is if you're wrong, you can still make money. Here's what I mean. If Apple drops down to, say, here even to 157, and it comes up and down, and as long as it finishes above $100, you make money. In fact, Apple could finish $1.34 lower. Okay, so it can finish at 98.70 something, and you still make money. Why? Because you got this margin of error cushion, margin of safety cushion. See this $1.34 that you got paid, you subtract that from $100, and that's your break-even point. So as long as Apple finishes up, did I say Microsoft earlier? I'm sorry. As long as Apple finishes above that, you don't lose any money. Now, what if it finishes below that? Okay, if you sell a naked put, meaning the worst thing that can happen is you pay off your option and you get put the stock. What that means is now you own Apple at whatever price it finishes at on the expiration date. So you were at with Apple at 100, almost $113. You were betting it'll go higher, right? Let's say it doesn't, and you hold it all the way to expiration, and it finishes below $100. Let's say it finishes at $95, for example. If you don't close your option early and you let it expire here, okay, the worst thing that happens is you pay your, you pay your loss, but now you own 100 shares of Apple at whatever $95. Okay, so that'll cost you $9,500, right? Because you own Apple at nine. What I mean, you're gonna own $9,500 worth of Apple. Okay, because per 100 shares, that's it. Okay, and then that's it. You can, of course, then you hold it and wait till it goes up. Now, here's a neat part about options. You have the option to hold it till this time. You don't have to hold it until this time. Okay, so for example, let's take the same example and I'll shorten it. Earnings is right here, right? On January 27th, after the market closes. So you go, well, I'm bullish. I mean, I just read something. Apple sort of bought a bunch of iPhones, and yeah, so I'm betting the stock will go higher. But I don't know if it's gonna finish higher than this in March, Mark. But I figure it'll spike up a little bit. Okay, so go to your trade page. Here's when you hear Tom and Tony when they trade earnings, they trade weekly. See the stuff in red? So see over here in January, you can pick one expiring January. Oh, that'll be too late. Let's look. You're looking at one that finishes at the January 27th, so the month ending in January. So you go to trade. You're going to go to the weeklies. And no, that expires in 6 days, so you can't trade that. You gotta trade this weekly expiration here. It expires February 1st, 2015, I believe, the first week in February. Okay, so look where earnings is. Earnings is right here, so it's gonna expire that week, like February 1st. Like where is it? Like right around here. Okay, so oh man, you're thinking, okay, for sure by that date it'll finish higher, right? Well, here's what Tom and Tony mean. If you look, the IV for that week is that expiration is 43.12, not as high. It's not above 50, but IV rank, as you will see on the chart, is still above. See, IV rank is still high. Why? Markets moving down and earning. Anytime earning comes up, you'll see IV rank. So let me show you what Tom and Tony mean by IV or IV rank is the only thing you can count on for reversion to the means. Look what happened the last time they had earnings. See right here? IV rank shot up, and right after earnings, look what happened. Well, it started dropping before earnings because probably news got out or people were bullish. But look what happened after earnings. Bam, it dropped. That's where you make your money. See this? So look where we are now. We expect IV rank to climb, and right around this time, right after earnings, it'll drop, and that's what you're gonna bank on. All right? That's guaranteed. It'll drop. Direction we don't know. So what if you sell the put expiring in 13 days, which is right after earnings, and it's trading at 112? You figure it's going to be higher than that, right? So what if you sell any one of these, right? And here's your probability of being right on this weekly. You say, "Wow, I'm really bullish, Mark. I think it'll be a finish above 112." But let me give you a margin of safety. Well, what if it goes wrong? What's the volatility? I mean, what's the expected move? See this line right here? $7.50 plus or minus. So they think Apple can drop $7.50 up or down. So take it, subtract $7. 1, 2, 3, 4, 5, 6, 7, and 50 cents, so 104. You could sell the 104 put. So what you're betting is right after you're betting earnings that'll go higher. Okay, but you guarantee what you're seeing. You feel that no matter what, it'll stay above $104. What are your chances? You have an 82% chance of being right. See what I mean about the golden gecko? One standard deviation, about 84%. So you could sell this for 83 cents, right? Betting that it'll stay above $104. Now, somebody asked the question, well, why do you sell the calls in? Well, look at the calls, right? It's a $7.50 move, right? Where are we now? 112 here, right? So count $7.50 up. 1, 2, 3, 4, 5, 6, 7. So 120, right? Look, if you sell the call side, the bid, 1, 2, 3, 4, 5, 6, which is the 120 strike, you can sell that for 95 cents, right? What you're betting now is you're betting that the after earnings or at the end of that week, it'll finish below $120. So on one hand, you're betting that it'll finish above 104, and on the other bet, you're betting it'll finish below 120. What are your chances of being right? You have an 81% chance of being right. See that? And then the guy you're going opposite of has only an 18% chance of being right. So you're covering the spread. The spread is plus or minus $7.50, and you're going to collect 83 cents, or you can make $83 per contract on one side, and then you can make another 95 cents or $95 per contract on the other side, and you're selling it. Okay? So then look what happens on your chart. So here's earnings, right? So, okay, what you're betting is where's 120? You're betting it'll stay below 120. Okay, but remember, you collected 95 cents. So as long as it stays below $120.95, you don't lose any money. And as long as it stays above 104 and, well, basically 103.15 or so, because take 104 minus 83 cents, that's your break-even point. So between these two lines almost, not quite, just two, but anyway, so between one, I'll zoom in real quick so you guys can see. All right, so you're betting it'll stay below 120, this line right here. You're betting that on this it'll be below 120, right, and above 104, which is down right around here. All right, that's it. That's what really a golden gecko is. That's a triangle actually. And a golden gecko is you buy the wings, so to speak, so to protect your protect your position. Now, if you really, let's say you're like, that's how you play both sides, meaning you're kind of betting that IV rank will drop first of all, and you make money on the put side and the call side. You just want it to stay in the range. You don't want it to shoot above the range. If you're now, here's where people get burned, because it on earnings, if it moves too much, like look at this. See Apple back in when was this? This was April 2014. See, after earnings, Apple shot up, right? But it shot up more. It might have shot up more than more than its expected move. And if your options expire that week, you're gonna lose money. All right. So that's the risk. That's why for new people, I say stay away from stocks. You know what I mean? Just trade ETFs. But I wanted you guys to understand the cost basis reduction. So that's why I want to talk about selling the puts. Let's say you only do one side, so you sell the put, right? You're selling the 104 put. So you're betting that at the end of this week, on February 1st, which is right around here, okay, after earnings comes out, it'll finish above 104. It can shoot as high as you want. You're still not going to lose money, but the most you can make, if you sell this 104 strike, the most you can make is 83 cents or $83 per contract. All right, and you can cap your losses by buying, whatever, something up here, and you can cap your losses. But anyway, that's what I mean. That means you lowered your cost basis, meaning it's trading at 112. See, do you realize you can be right? You can be right even if Apple goes down. I'll go back to chart. Here's what's good about selling a put. You can be right if three things happen. You can be right if Apple stays the same. Of course, you're going to be right if Apple shoots higher. And you're even going to make money if Apple shoots lower, as long as it doesn't go below 104. All right? So the only way you can lose money if it shoots way below 104 by February 2nd if you're selling that weekly. I hope that helps. If you have any questions, give me a shout out. You guys have a great weekend.